Welcome to this UAE specific course on taxation. In this session, we'll cover the three key pillars of the UAE tax system: corporate tax, VAT, and the unique absence of personal income tax. We'll also explore how free zones and designated zones impact taxation and touch on the OECD global minimum tax that comes into play from 2025. By the end, you'll not only understand the framework, but also see how these taxes translate into accounting entries and compliance steps for businesses operating in the UAE. The UAE stands out globally by imposing no personal income tax. Whether you earn a salary, run a freelance business, or generate returns from investments such as shares, real estate, or even crypto assets, your income is not taxed. Similarly, there is no inheritance, gift, or wealth tax. These advantages apply equally to UAE nationals and expatriates, which is a key reason the country attracts talent and investment. Example, if you receive 20,000 dirhams monthly salary, no tax is deducted. Gross salary equals net salary in UAE. In other countries, you might record salary gross 20,000 dirhams, less income tax 2,000 dirhams, net salary 18,000 dirhams. In UAE, no such tax entry exists. Corporate tax introduced in June 2023 applies at 9% for businesses earning profit over 375,000 dirhams. To support small enterprises, profits below this threshold remain untaxed. Every entity, whether mainland or free zone, must register, even if they expect 0% tax. Certain activities like natural resource extraction remain exempt. Tax returns must be filed within 9 months of the financial year end alongside audited accounts. Example, company earns 500,000 dirhams net profit in 2024. Taxable income above 375,000 dirhams equal 125,000 dirhams. Corporate tax at 9% equals 11,250 dirhams. Journal entry, debit, corporate tax expense 11,250, credit, corporate tax payable 11,250. From 2025, the UAE will apply the OECD Pillar 2 global minimum tax rules. This impacts multinational groups with revenues above 750 million euro. If such a company's UAE operations pay less than 15% effective tax, a top-up tax ensures compliance with the global standard. For example, a multinational paying only 9% in the UAE would face an additional 6% top-up. This measure doesn't affect SMEs or startups. It specifically targets large global players. Example, MNE earns 100 million dirhams in UAE, pays 9% equals 9 million dirham tax. Effective tax rate equals 9%. Top-up required equals 6% of 100 million equals 6 million dirhams. Journal entry, debit, tax expense 6 million, credit, tax payable 6 million. VAT was introduced in 2018 at a standard 5% rate. It applies to most goods and services, but key sectors like exports, education, and healthcare can be zero rated. Residential rent and certain financial services are exempt. VAT registration is mandatory once taxable turnover exceeds 375,000 dirhams, with optional registration from 187,500 dirhams. Registered businesses must issue compliant tax invoices and file VAT returns either monthly or quarterly. Example, company sells goods worth 10,000 dirhams plus 5% VAT equals 10,500 dirhams invoice. Journal entry, debit, accounts receivable 10,500, credit, sales revenue 10,000, credit, VAT payable 500. Free zones provide strong tax incentives such as 0% corporate tax for qualifying income, mainly foreign or intra-zone transactions. To maintain this status, companies must not conduct commercial activity in the mainland. On VAT, designated zones are treated as outside of the UAE for goods, making some transactions VAT exempt. However, services remain subject to VAT. Businesses in free zones must still register for VAT and corporate tax and maintain separate books to prove compliance. Example, FZE earns 1 million dirhams from export sales, qualifying income, taxed at 0%. 200,000 dirhams from mainland sales non-qualifying, 9% tax applies. Journal entry for 200k dirhams mainland. Debit, tax expense, 18,000. Credit, tax payable 18,000. Compliance in UAE taxation is straightforward but strict. All businesses must register for corporate tax and VAT where applicable. VAT invoices, periodic returns, and record retention for 5 years are mandatory. Free zone entities must annually prove qualifying income to retain exemptions. While individuals enjoy zero filing obligations, penalties for late or incorrect business filings can be severe, ranging from fines to business restrictions. Staying organized and proactive is the best defense. To recap, the UAE offers a uniquely favorable environment with no personal income tax, a modest 9% corporate tax, and a manageable 5% VAT. Free zones provide targeted benefits, while OECD global tax rules affect only the largest multinationals. The bottom line, compliance is not optional, but if managed correctly, the UAE remains one of the most business-friendly jurisdictions globally.